Welcome to The Explainer. I am absolutely pumped you're tuning in today. You can think of me as your analyst older brother, because today we're going to completely level up your fundamental analysis game. We are diving deep into the master toolkit of corporate profitability. By the time we wrap up this session, you're not just going to be skimming financial numbers anymore. You're going to be reading the actual story of a business. So let's grab our toolkits and just get right to it. Okay, let's kick things off with a real head-scratcher of a paradox. We've got two absolute titans of the Indian market. Asian Paints has a return on equity, an ROE, of 27%. ITC also has an ROE of exactly 27%. Same exact number. So they're the exact same type of business, right? No way, not even close. These two companies have entirely different business models, totally different operational realities, and completely different risk profiles. The surface-level math is identical, but the story behind it couldn't be more different. I'm going to show you exactly how to crack this paradox open today. So, here's our roadmap for this mentoring session. First, the power of ratios. Then, we hit the big three pillars of profitability. After that, we unlock the DuPont master key, which is going to solve that Asian Paints and ITC paradox for us. Then we'll touch on some sector nuances, specifically banks, and we'll finish up with the literal secret weapon used by the pros, the magic formula. All right, section 1, the power of ratios, and why absolute numbers, well, they just lie to us. Picture this. You're scrolling the news and see a massive headline. TCS earned 46,000 crore rupees in profit. Now, is that good? Is it bad? Honestly, without any context, we literally don't know. I mean, it sounds huge, sure, but what if it took a quadrillion rupees of investment just to generate it? That's exactly why absolute numbers are fundamentally flawed. But when you look at the ratio, like TCS's ROE is 50%, that tells us the whole story. It means for every 100 rupees of shareholder equity left in the business, TCS is generating 50 rupees of profit. That is insane. It makes them one of the top 5 in the world. Ratios are your best friend because they completely level the playing field. They make companies comparable across size, across currency, and across completely different industries. Moving right along to section 2, the big three pillars: ROE, ROC, and ROA. Let's open up the toolkit. First up is return on equity, or ROE. The math is pretty straightforward here. Net profit divided by shareholders' equity. This is the most popular ratio out there because it answers the ultimate bottom line question for us shareholders. For the money we left in this business, what kind of return are we actually getting? Now, older brother rule of thumb time. Hitting 15% or more consistently over the years is the hallmark of a good company. Hitting 25% or more, that's exceptional. But I've got to warn you, ROE has a massive blind spot. A company can artificially pump up its ROE by taking on a mountain of debt. More debt means less equity, which mathematically shrinks the denominator and inflates the ROE. Always, always watch out for the leverage trick. Just to ground this in reality, if we check the FY24 data for some major players on Dalal Street, TCS is just a monster at around 50%. And look, there are our hook companies, Asian Paints and ITC, sitting right next to each other at roughly 27%. You'll notice HUL and HDFC Bank sitting in the middle pack there at 22 and 17%, while Reliance is hanging out down around 9%. These are completely different industries with very different capital requirements. But again, the golden rule: we need to know if any of these impressive numbers are just being propped up by debt. And honestly, that brings us to our second and frankly superior metric, return on capital employed, or ROCE. The formula changes a bit here. It's earnings before interest and taxes divided by total debt plus equity. This right here, this is the truth teller. By putting debt back into the denominator, ROCE completely eliminates that leverage trick we just talked about. It exposes the pure, unadulterated operational quality of the business. In fact, if you've heard of coffee can investing, this is their cornerstone metric. Those analysts are famously hunting for companies that can maintain an ROCE of 15% or more consistently every single year for a decade. Now, let's run those exact same companies through the ROCE filter. Notice anything wild? Hull is sitting at a massive 120% ROCE. Why? Well, because they have an incredibly asset-like business model paired with a premium brand that gives them insane pricing power. Meanwhile, our Asian Paints and ITC paradox has shifted just a tiny bit. Asian Paints is at 32% ROC and ITC at 30%. So this confirms both are super high quality, but we still haven't figured out exactly how they're getting those numbers. Hold that thought, we're going to solve it in just a second. But before we do, here's the third pillar you need to know: return on assets, or ROA. This is simply net profit divided by total assets. You're generally going to pull this one out when you're dealing with asset-heavy companies, or, very importantly, when you're analyzing banks. The quick heuristic to remember here, an ROA of 1.5% or higher is considered really solid for a bank, while industrial companies should be aiming for something north of 5%. All right, Section 3, the DuPont Analysis, the master key. This is the moment I've been waiting for. Imagine we're standing at a whiteboard right now. Back in the 1920s, the folks at the DuPont Chemical Company essentially said, hey, let's not just look at a flat ROE number. Let's break it down into its 3 core engines. Step 1 is the net margin, basically how much profit you're actually keeping from every sale. Step 2 is asset turnover, how efficiently your assets are generating that revenue. And step 3 is the equity multiplier, which tells you how much financial leverage or debt you're using. The genius part? If you multiply margin by turnover by leverage, you get right back to the exact ROE number. But now you've lifted the hood and can see exactly how the engine is running. So here is the big reveal we've been waiting for. Let's run Asian Paints and ITC through that DuPont tree. Check out ITC. They've got a massive net margin of 26%, literally double that of Asian Paints. But look at asset turnover. Asian Paints turns over its assets 1.8 times a year. They are an ultra-efficient operator, just churning out paint and selling it incredibly fast. ITC, on the flip side, turns its assets over pretty slowly at just 0.7 times. When you multiply all the pieces together, yep, they both hit that magical 27% ROE. But the reality of the business models? Asian Paints gets there by being this hyper-efficient, fast-moving machine. ITC gets there by relying on a massive margin consumer business that turns slowly, with just a little bit more debt sprinkled in. Boom. Paradox solved. Moving into Section 4, sector nuance and margins, specifically the banking exception. Now that you've got the master key, we've got to test it on the absolute trickiest sector in the market, financials. Banks are kind of their own beasts, right? They play by slightly different rules. Take HDFC Bank versus Bajaj Finance. Banks naturally have a super low asset turnover. I mean, they deal in money, not buckets of paint, and they naturally operate on huge leverage. HDFC's equity multiplier is sitting all the way up around 7x. But look at how Bajaj Finance wins the ROE game. They actually use slightly less leverage than HDFC, and they've got slightly better turnover, but they drive a much higher net margin of 30%. Why? Because they focus heavily on high-yield consumer lending. It's that margin difference that ultimately pushes their overall ROE above HDFC's. I want to take a quick beat here and look at this quote from the valuation guru himself, Aswal Damodaran. He says, "Growth unaccompanied by excess returns creates no value." That is absolutely profound. Look, math is really just the language we use to describe a business model. If a company is growing its revenue to the moon, but its return on capital is lower than the cost of that capital, that growth is literally destroying shareholder value. To get those excess returns, you absolutely need margins. So how do we get those excess returns? It's all about the layers of margins. Your gross margin tells you about pricing power. HUL's 50% gross margin, that means they can charge a premium just because people love their brands. Operating margin shows you how operationally efficient the core business is. And net margin, that's the final reality check after the taxman and the banks have taken their cut. But listen, here's my ultimate older brother advice to you. A single year's margin means almost nothing. The absolute secret is the trend. If gross margins are slipping from 45 to 42 to 38% over 5 years, their pricing power is literally evaporating. But if those margins are slowly, steadily climbing over a decade, you, my friend, have found a compounding machine. Finally, Section 5, the secret weapon, Greenblatt's magic formula. I want to leave you with one last tool for the kit. It's a legendary methodology created by Columbia professor and hedge fund manager Joel Greenblatt. What's brilliant about it is just how incredibly simple he made investing. Step 1, look for a high earnings yield. That's EB divided by enterprise value. It basically tells you the stock is cheap. Step 2, look for high return on capital. We already know that one. It tells you the business is high quality. Then you simply rank the entire market by the top 30 stocks that are both cheap and high quality, and you just rebalance it once a year. It sounds way too simple, right? No way it works. But check this out. An academic backtest of this exact formula in the Indian stock market from 2012 to 2020 showed an average return of 13.9%, comfortably beating the Sensex's 9.3%. Cheap and high quality for the win. Okay, let's pull all of this together. Here is your ultimate summary checklist. You're looking for companies hitting that 15% ROE and 20% ROCE consistently. When you spot one, immediately break out the DuPont analysis to uncover how they're actually pulling it off. Are they an efficient operator, or are they just juicing the numbers with debt? Keep a close eye on those 5 to 10-year margin trends to spot genuine pricing power. And please, never look at these numbers in a vacuum. An 18% ROCE is fantastic if the industry average is 10, but it's pretty terrible if the industry average is 30. So, I'm going to leave you with a bit of a challenge. Right after this explainer, pull up your favorite stock screener. Look up the one stock you are the absolute most confident in right now. What is its 5-year ROCE trend? Is it actually creating excess value, or is a massive absolute profit number just fooling you? It's time to put your new toolkit to the test. Thanks so much for learning with me today, and I'll see you in the next explainer.